What is life insurance? Life insurance is us transferring risk. We transfer risk from ourselves to someone else. So when you have car insurance, again, insurance, you're transferring the risk that an accident is going to happen to you to Geico, to Allstate, right? If something happened, they're going to pay. In reward of transferring that risk, you pay a premium. You pay them for taking the risk. They're taking the risk on them. With life insurance, we pay the risk of us dying to someone else, to the life insurance company. In this case, let's call them National Life because we love them. And if you die, they're gonna pay someone. Insurance divided into two categories: temporary insurance and permanent insurance. Temporary insurance is insurance we buy that's good for 1 year, 5 years, 10 years, 20 years, or 30 years. The one is called ART, annual renewable term. The cheapest one, the most expensive one. If you die within that period of time, the insurance company will pay. When it came to an end, no more insurance, went to the garbage. Okay, so if you buy $1 million for 20 years and you died within those 20 years, the insurance company will pay $1 million to whoever you ask. Now, whoever you ask is called beneficiary. Okay, the person that buy the insurance on is the insured. There's one more thing, it's called policy owner. Who owns the policies? You can own on yourself, you can have your wife. Why would people buy that? It's dirt cheap. If you buy a new $1 million 20-year term today, you'll pay $15 a month. A cup of Starbucks is worth $1 million. The chances the term insurance pays, all right, the risk is about 2%. So only 2% of the people that buy that insurance actually die while having it, right? So the insurance company love it. It's a great money maker. Why do we need to buy it? And why people buy it? I got married. My wife is pregnant. If I die, what's gonna happen to my son? Right? Now I cannot. This thing is expensive. If that costs over here $10, that would be $100 a month. All right. So lots and lots of people, and actually majority of people, that's the insurance they buy. It's cheap. Okay, and it's there just to cover the risk of death. People say term insurance suck. They don't pay because most people will outlive it, right? If the insurance company think you're gonna live more than 20 years, that's what they're gonna give it to you. If they don't think you live those 20 years, they're going to decline you. The insurance companies go through a process called underwriting. When you want to buy insurance, they want to make sure that you're not going to die soon. Because people that wants to die soon try to buy insurance, right? So they go through the process called underwriting to eliminate all those that shouldn't get the insurance. But he does have a very important role in protecting our families, people we love. That's what term insurance is. Sometimes, other than family, we use it in business. If I hire you and you are my key employee and you die, my business taking a big loss. It's going to take me a long time to replace you. And that's called key man insurance. What else we use term insurance for? It's called buy sell. We're partner in business. And if I die, my 50% goes to my wife. She's not contributing anything to the business. You're going to get $1 million to buy my shares for my wife. So that basically gives you the business and my wife the money. So that comes with an agreement, okay? But that's how people use term insurance, typically. Vast majority of it is to protect the family, the one they love. And there's a whole bunch of products, okay? First one is called Whole Life, okay? Second one is called Universal Life. Whole Life is an insurance product that's, if you do it correct, will go with you all the way to age 100 or 120. So not like term insurance that disappears after 20 years, you know it will actually pay. Okay? But it's expensive. As we said, if that costs 100, that will cost, if that costs $10 a month, that will cost $100 a month. But what the insurance company do, there's a saving component. So when you put $100 into the insurance product, $10 goes into buying the risk component, right? And then with the leftover, the insurance company invests it, and with its profit, they give you a dividend, okay? And they decide whatever they want in the end of the year to give you as a dividend, and that money grows with no taxes, tax free. Cash value inside life insurance grows tax free. So it's a great saving component, not like your checking account or stocks. Every time you sell a stock, you need to pay taxes. Over here, you never have to pay taxes. Now, he has the death benefit, right? And if you do it for retirement and you want to take money out, you can always borrow against it. So you have access to the money. And if you borrow against it, you can use it down the road, or you can save it for emergency funds. And it's kind of a hidden piggy bank. Another cool thing that's really good about life insurance is the cash value inside the life insurance. Nobody can take it from you. So it's creditor protected. Different state, it's different limit. But if you would decide to sue me and my money is inside life insurance, you can't touch it. Whole life is a great product. However, it's very, very stringent, not flexible, and expensive. You like cars? Lamborghini, right? It's expensive, it's drive fast, but it's this high from the road, you feel every bump, and it's expensive as hell to maintain. Another product that's in the market is called Universal Life, and it's a lot more flexible, but there's different kinds of Universal Life, and I'll break them down based on the risk and how they work. So the first one, the most conservative one, it's called GUL, Guaranteed Universal Life. It's almost like a hybrid between the whole life and the term. It doesn't have cash value, but it's guaranteed to go to age 120. So you'll go to age 120 or age 100, okay? But there's no cash surrender value. Cash surrender value is the cash that's inside the policy. So it's kind of, for certain use cases, it's good. It's if you want to make sure your family gets the money, you don't care for income or retirement, and you want it to pay because the term insurance doesn't pay and the whole life is way too expensive. Let's call this one a BMW. Does the job. Soft, it's flexible, but very reliable. Next one is just a UL. Some will call it current assumption. And that is very similar to the whole life. Okay? In fact, that there's a cash value, cash surrender value, and it's decided by the company, so it's dividend or crediting rate. That's the words for it. But it's flexible. It's a lot more flexible than the whole life. You can skip a year, you can reduce, you can play with it. Not as popular anymore because the dividend is really low now. Okay? With the whole life, the dividend used to be 8-9%. Today you're looking at 4 to 5%. Over here we're looking at about 4% today. All right? Then there is my favorite product. It's called IUL, and I stands for index. And what index does is instead of getting a dividend that those two guys get, you get what a certain index does. Familiar with the S&P 500? For example, S&P. So you take that decision making out of the insurance company. IUL, when the market goes up, you get what the market goes up. Okay? Certain indexes as a cap. And a cap is basically a ceiling. You can only make 10% a year. That's it. If the S&P does more than 10, you don't get it. All of them have a floor. So if the market is going down, floor stops it down, and you never make less than a zero. Now, if it grows in tax free and it's averaging over here 6% plus, and it's cheaper, we can use it, one, to protect our family, two, and most my clients use it for, is retirement planning. Because the money grows tax free, and when you want the money, you take a loan, so you never pay taxes on it. And it's an awesome financial planning tool. All right? While protecting the family, and we'll touch on it, there's something called living benefits. And living benefits today, many product has. I love living benefits a lot. I talk about living benefits a lot. And living benefits is we buy insurance not in case we die. We buy insurance for when we're alive. So that covers us, for example, if we have cancer, if we have stroke, we have heart attack. Our chances, oh, three in the room, one of us is going to have it before the age of 65. It's a 30% chance. It's horrible. So why not transfer that risk to the insurance company? And if we have cancer, stroke, or heart attack, they'll give us $1 million to focus on being with our family, staying healthy, picking the best doctor in America. Right? So I talk a lot about that. It's one of the biggest reasons I sell National Life. They have the best living benefits in the market. Everybody wants to retire. And that's my approach, is attacking it through retirement. It's a Tesla. Right? It's efficient. It can be fast. It's luxurious. Expensive as well. Right? But it's more efficient. Last product is called VUL. And what that is a universal life like the other one, but instead of an index, it means variable. So you buy stocks inside. And you say, that's not a bad idea. Buying, selling, and selling stock and not paying taxes, which is true. It is a great idea. The only problem with VUL is there's no floor. So when the market goes down, your money's gone. That's not a good retirement plan. Retirement plan is, in my opinion, right? You'll hear me talk to hundreds of people. Everybody has a different opinion of what a good retirement plan is. Some are willing to take more risk, and the longer you go over here, you take more risk on you. Okay? Because in whole life or in GUL, there's no risk. You know what you're getting. When you get a Lamborghini, you know it's going to go 100 miles an hour. You get a whole life, you know they pay guaranteed dividend, 3.5%. You don't have the guarantee over here. But historically, you can see that this one generates 4%, this one generates 6%. So over a long period of time, this one will be better. But you take risk on you. This one is a potential of generating 50% if you buy the right stocks. But you can also lose some more risk.